It's a funny one. It's kind of like insurance. You don't need it until you do. We saw USDC depegged. Why did depeg? Because there's dollars in a bank account, and people woke up one morning and realized that the bank that those dollars were in no longer existed.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed. What's up, guys? Welcome back to another episode of 0x Research. Today I'm joined by Luke from the Blockworks research team and Michael and Colin from Liquity, a decentralized stablecoin protocol. Colin, Michael, thanks for joining.
Thanks for having us.
Before we get started, do you guys want to tell us a little bit about what Liquity is and what you guys are building over there?
Sure. So for those that don't know, Liquity is a CDP-based borrowing solution with a stablecoin called LUSD. It has been around for 3 years. People have issued more than 4.6 billion in loans. It's one of the most forked protocols on Ethereum. DeFi protocols. And it's running, it's immutable. It's running for 3 years without any problems so far. So it's really one of the few truly decentralized protocols. And what does it do? So what can the users do with Liquity? If people hold ETH and only ETH, they can borrow against it. So a user would deposit ETH into Liquity, then they can take out a loan in LUSD and use that for buying a car, for using it in any other way. I think the specialty of Liquity is really that it's fully decentralized. You have only a one-off fee, kind of that was an innovation. You don't have an interest rate. You only pay 0.5%. And LUSD has the reputation of being really a sound and sovereign stablecoin, like the unstoppable stablecoin in DeFi. I think that, in a nutshell, is Liquity, and that's the version 1. So we're working on a V2, and I can tap kind of what's coming there. But maybe first, Colin, did I miss anything important about Liquity?
No, I think it was beautifully said. So, very much focused on decentralization. It's very much in our ethos. We do what we can wherever we can to reduce any points of centralization. And we kind of run the gamut on that, including the fact that we don't run any of our own front ends to access our application. Everything is open source and put out so people can run them themselves, and something we're very passionate about, and we think will help push the space forward.
Interesting. And I definitely want to get more into that focus on decentralization later. But before we get into that, maybe you can explain what Liquity V1 was or is, given that it's still running.
Yeah, so you mean V1? I mean, I hope I explained that a bit by saying it's a borrowing solution, or are you rather V2?
I guess I more so mean what is changing from V1 to V2 is a better way to put it.
So mainly two things, One is really something a lot of users asked us is, can we have other collateral, especially LSTs, having a yield-bearing collateral? So V2 will introduce multi-collateral, where the protocol will accept ETH, Lido staked ETH, and Rocket Pool ETH. So they were really, again, restrictive because we want to keep the key properties of Liquity V1 people like this immutableness, kind of decentralization, no upgradability. So V2 will be in the same, will have the same qualities. That's why we are restrictive with the collateral. You can't play around and change it later. So that was a user need which we address with V2. And the other one was shortcoming of V1, which was designed in a low interest rate environment where it worked fine with the one-off fee. But lately, as interest rates rose, this had negative consequences for the borrower, which had to have really over-collateralized positions, and we can deep dive later into that, why that was. So we introduced kind of the innovation of user-set interest rate to address that challenge, to allow people to borrow with, again, high LTVs in all interest rate market conditions. And I think these two ideas together nine months ago, then really kicked it off, where we asked ourselves in a retreat, how would we build V1 today? What are the learnings and how can we improve it? And mainly because nobody else has done it. We were forked a lot, but kind of we didn't see this um, really substantial innovation. So that's how it started, and that's the main difference.
So V2 will also be immutable and no governance.
Yeah.
What's the choice behind that? Why are we going fully immutable and governance free as opposed to some alternatives?
I'm happy to jump into that. So yeah, something that actually really surprised me. I know Michael and the other guys had been around and seen it, so maybe it became more innate. But um, when we talk about immutability and decentralization, I think a lot of people kind of think about this as really the hardcore ETH maxi crowd are the only people that care about this. And what really surprised me when we started talking to users was some of our biggest, most advanced, I guess, DeFi institutionals is probably the best way to talk about them. Multi-billion-dollar businesses. They said, "Hey, we really like Liquidity for a lot of reasons, but one of the reasons that we care most about is the fact that you guys can't change the rules. Like, you have no more rights than we do." And that blew me away to understand that people cared about immutability and decentralization for a reason that isn't idealistic, philosophical. That they can actually reduce their risks because they understand a protocol, they understand where it can be attacked, and they understand that it can't change the rules later on down the line if somebody says, "Oh, we don't like this" or "We don't like that." So that is something that I think is truly undervalued in the space. Now there are a lot of benefits of being able to upgrade your protocol and change things, but I think from a user's point of view, it's great to know that the things will always work the same way that they do. Look no further than how Uniswap V2 works. That's still one of the biggest DEXs out there, and it can't do anything differently than it did when it was launched years ago.
So, given that Liquidity V1 and the LUSD contracts were immutable and governance free, what were the primary limitations or problems that this might have introduced for the overall mechanism design of V1 that ultimately created the context for the need to build Liquidity V2?
Yeah, I can talk about that. So the first one is, and apologies, it's going to be a bit financial and a little bit academic. But generally, the idea here is in V1, a user that wants to borrow LUSD, um, like if they were to borrow DAI from Maker, needs to put in collateral. So for us, it's just ETH. It's just one collateral, and they can withdraw LUSD. Now, when they do that, they pay an upfront fee that's 0.5%. It changes a little bit depending on demand, but it's a one-off fee. After that, they pay nothing. So you can imagine that a protocol that says, "Hey, you can mint money for 0.5% and keep that borrowing position as long as you want." At some point, when somebody else like Maker or Aave is willing to pay you on stables 5, 6, 7, 8, 9, 20, 30% with Athena, you can imagine there's an imbalance there. So the way that V1 kind of handled that is by saying, well, we have this unique mechanism that we call redemptions. What is a redemption? Redemption is something that's unique and focused on decentralization. And what it allows is anybody that holds one LUSD is able to turn around and grab $1 worth of Ether from a Liquidity V1 borrower, essentially close off their loan. Now, it's not a liquidation, it's something very different that's based off of the least collateralized loans in the case of V1. What that meant is that the average loan, or to be safe, you need to put ever more collateral on the back of that. Here's the academic part. You can kind of think of that as an embedded interest rate because by placing ETH in there, you need to pony up that ETH, but you're also losing money versus what you might get out of a staking revenue or the ability to put that in something like Aave and earn a rate on top of that. So it's by foregoing any interest you would earn on that and actually funding to put that money up, controls how much LUSD you can get. So you really do arrive at something that is an equilibrium, but it's not directly felt in an interest rate like you would see in a more traditional protocol. Currently, fast forward to kind of the higher interest rate environment. Right now, you need to put in roughly $4 or $5 per dollar you borrow. When you compare that to another protocol like a Maker or like an Aave, it's generally 2 to 3 times higher than they would be.
And why is that? Just to dumb it down, it's this arbitrage trade. People borrow cheaply in V1, then they exchange it for another stablecoin where they get more yield. By exchanging it, you sell it, you dump it. So you don't have a demand, and if you sell it, the stablecoin would go below peg, and that's kind of the second function of the redemption is to restore the peg. So if LUSD is below peg, people go and redeem, which is good because the peg is kept, but it's not so good for the borrowers because they get redeemed. How can they avoid it? By collateralizing more and more their positions to not be redeemed, to be higher. So it's a race that goes up, and that was kind of the main challenge. And there is also where the innovation of user set rates come in, which provide another way to create this balance between supply and demand of the stablecoin.
Yeah, so to address some of those problems, V2 introduces user set interest rates, which seems to be really novel and innovative mechanism that I don't think we've seen anywhere else. So while V1 facilitated redemptions from the troves that were paying the lowest loan to value, V2 will facilitate these redemptions from the troves that are paying the lowest interest rate. Additionally, users can delegate this authority to a third party or some other contract. So I'm curious, at large, what behavior do you expect to see out of users? Do you think they will pay in line with prevailing market interest rates? Do you think they'll undercut market rates to get the cheapest place to borrow? Or do you think they might pay a premium to the market rate to avoid redemptions?
Yeah. So kind of in our scenarios, we see kind of three phases. So in the initial phase, it's very much that people will follow uh, what others are putting out there. So people will look and say, how much do I need to pay to borrow in Maker? That sounds about right. I'll pay that. And there probably would be a lot of grouping around that because people really don't know what to do. Um, After we arrive at an equilibrium, and it may be that in the early days, people have to pay less or more because of other factors that are in the early stage of the protocol for a variety of different reasons. Once we've kind of crossed that early, hopefully few days, maybe a couple of weeks, and people start to become familiar with how the protocol works, we're starting to see kind of a bigger dispersion. And what this means is some people go, all right, this is where I'm worried about the risk, and I want to move away from that risk for reasons like taxable events or maybe needing to rework on the collateral. If the market moves, I get redeemed, and then the market moves up. Well, that means I lost some opportunity there. So they want to avoid that, and they're willing to say, I'm willing to pay a little bit more than the average, and maybe this is in line with somebody like an Aave or a Maker. Maybe it's slightly better, and I'll come back to that. But there's also other people that go exactly that question: how far can I push this? What's the least I can pay to borrow? And we'll see more sophisticated actors that have greater technology trying to push that down so they can arb inside the protocol or outside of this. And then kind of the third phase where we hopefully grow larger than that is the protocol itself starts directing what a rate can become. And we talk about a DeFi reference rate. And what do I mean by that? If we look at traditional financial markets, there are lots of different rates out there that are reference rates. So the one that we talk, depending on when the show comes out, the federal Fed's funds rate, the reserve banks, set an interest rate that the U.S. government has to pay for debt as it passes through the Federal Reserve banking system. Now, people look at that rate and they look at the number of, does it go up or down? How many bips? That is the reference rate. That's what everybody kind of glues around. It's the Schelling point, so to speak, in the dollar financial markets and the global financial system. What we're hoping to do is grow to a space where maybe we don't become the only rate, but we become one of the main rates where people look to and say, how much does it cost to borrow dollars in DeFi? That's where we want to become. If we're able to reach that, that can open up a whole new kind of Cambrian explosion of other DeFi protocols that want to build on top of interest rates, and they want to do this efficiently. Because coming back to the previous point that I wanted to hit on, and we'll come more into this, but the protocol passes all of that borrowing income directly back out to stablecoin holders and users, liquidity providers. It's 100% pass through, so it should be as efficient as we can possibly get inside of DeFi. So the hope is that we can quickly kind of get to that sustainable and dispersion, and then we get to a point where people start using this above and beyond just using a stablecoin and borrowing system.
And maybe to touch on that and explain what it means for users, or why we think we too can create this benchmark rate for borrowing in DeFi. I think it's important to understand the mechanism of the interest rate and how market driven the solution is. I think it will be one of the most market driven CDP solutions out there. And as I said, it's the interest rate will help to create this equilibrium between borrowers who mint a stablecoin and the holders who hold it. Because also in a CDP system, you need both sides. And you see if the sides aren't in an equilibrium, they depeg. We have seen that with Go, which had to find ways how do you adjust that, and which had to go through governance and so on. And with V2, it's so beautiful. It's so direct. And it's amazing that nobody came up with that. And how does it work? So if you have the borrowers, and now we have borrowers that are very safe, so they pay a lot of interest. People that hold a stablecoin get a lot of interest, so we have a lot of demand. Then the peg goes over peg. A lot of people want to hold it, so naturally the peg rises. What does that mean is, okay, now some borrowers, they are not afraid of redemptions. Nobody would redeem $1 for $1 of ETH. It's economically not viable. So this signals to the borrowers, I can lower my rate. Or some borrowers would say, hey, I can go to 0.5% and borrow cheaply. So this means that then because there is less interest for the stablecoin holders, the demand decreases. And this means the peg is coming down to the point where it can go below peg. And if it's below peg, that's actually a signal from the stablecoin holders, you're not paying enough. So now borrowers are afraid that they get redeemed, and the people that don't want to get redeemed increase their interest rate. And with that, again, kind of the yield opportunity on the other side. So you have a very direct mechanism to bring the system into balance. And the beauty is it's not an algorithm like in lending markets or in Curve. It's not a governance. It's in the market's hands, in the user's hands. And you can think of it like carrot and stick to create the balance. The yield is the carrot, but now also the stablecoin holders have a very powerful thing. If they don't feel they get paid enough, they just sell the stablecoin and borrowers get redeemed. So that's really the stick. Hey, if you don't pay more, then we think the market should pay, you will be redeemed. So people need to pay more. So that's the mechanism that people need to understand. And that's why we think if it gets big enough, it really should reflect the market rate.
Hey guys, Permissionless, the event for crypto natives, is heading west to Salt Lake City, and we're bringing the biggest names in crypto together for an incredible can't-miss event. Join me and the rest of Blockworks on October 9th to hear from more than 200 industry titans, including Nick White from Celestia, Shriram from Eigenlayer, and Keone from Monad. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups, L2s, institutional adoption, and of course the November election that will be right around the corner. We couldn't be more excited about this event, and it's happening in one of the most beautiful places in the US. Ticket prices will be increasing towards the end of June, so get your ticket today. Make sure to use the code so I get some credit and bragging rights from the rest of the team. Use 0x10 for 10% off on your ticket. One more thing. We're also hosting the Permissionless III Hackathon in collaboration with BiddleBox. The theme this year is a multi-chain future, to build a better cross-chain experience so I don't have to have a heart attack every time I bridge to a new chain. All hackathon participants will receive a free ticket to attend Permissionless. So if you're a developer, come join us in Salt Lake City, team up with fellow devs, and build the multi-chain future.
So in V2, the interest revenues that are paid by borrowers will get paid to bold stablecoin liquidity providers to the protocol's stability pool. Could you touch on the role of the stability pool for backstopping the protocol and how this becomes a native yield venue for the bold stablecoin?
Yeah. So kind of in short, you can think of our stability pool as the place where we provide liquidity in the event of a liquidation. What does that mean? If there's a borrower inside the protocol who's borrowed Bold versus their underlying collateral, and they're no longer in a position where their LTV is sustainable, it's become under collateralized compared to our minimum collateral rate, Any user is allowed to liquidate them. It's as simple as kind of hitting a button inside the contract. Rather than most protocols which say, hey, you need to go out and source bold in the market, you need to bring that and you need to claim the underlying collateral against that now defunct liquidated loan. We source the bold that we need directly from the stability pool. You can kind of think of this as a fixed price AMM, because what happens is somebody who's placed bold, deposited bold in, loses that bold for the liquidation and receives ETH from under that in a pro rata share compared to everybody else inside of the system. It's not one person gets picked out at random or anything. It's a pro rata across everyone in that system. It's not at a 1-to-1 ratio. As somebody that's receiving ETH or an LST, you actually get a slight discount. So that means that for every dollar that's liquidated, you might receive $1.05 worth of ETH. You can pull this out whenever you want. You can swap it back into Bold, or you can swap it into another stablecoin if you so chose. Lots of people also decide just to leave the underlying ETH inside of that. But it's a way to kind of give a bonus back to people that are doing this, as well as paying them on an ongoing basis through that stability pool funding rate.
So with the stability pool as a native yield venue for the stablecoin, the more bold is supplied to the pool, I guess the less you can expect that yield to be. The less bold there is in the pool, the higher you might expect that yield to be. I'm curious what you expect that yield to bold stability providers to be as it relates to market rates. Then additionally, like at large, where do you expect to see bold utilized across DeFi and the crypto economy? With Liquidity V1 and LUSD, we saw about 50 to 70% of the LUSD supplied to the protocol's stability pool. And I'm curious what you expect that to look like for V2.
Yeah, great question. So for the first part, the protocol itself, as we said, passes out 100% of what it earns through borrowing. 75% is directed towards stability pool. The other 25% goes out, and I think we'll come into this later, into what we call protocol incentivized liquidity, PIL, which means is being directed towards people that are providing LP or some other growing initiative for Bold. We would expect that to look maybe like OTC or something like that. It's a very open protocol, and we'll come back to that. But the idea here is the rate that people are borrowing at, let's just pick a number and say 5% annualized. The hope is stability pool rates and PIL rates should be very closely matching to that. Maybe slightly above, maybe slightly below, but it should be very closely matched to that. Obviously, there can be times where there's more kind of reasons to pull Bold out and use it outside of that, in which case we might actually see moments where this comes up. Now, if we could also just see the absolute rates come down depending on the reason for that kind of exogenous pull of Bold away. Can I answer your second question? I think it would be very fair to look at the borrowing rate initially and the stability pool or PIL rate as probably very similar to market rates. I think I pulled out 5 or 6. It's probably not a million miles away for an unincentivized pool. The hope is, though, obviously that this can bring in more uses, get traction outside of that market. Any Bold that's pulled away raises that rate right up. Now, we can talk a little bit more about this and where there's kind of other incentives inside of that. But in kind of an equilibrium state, it might look something like that. Something to highlight there is, and we touched on this, if I'm doing the same thing in a more typical borrowing lending market, like an Aave or like a Morpho, I might get paid 1.5% to deposit, whereas to borrow, I'm paying 7%. So the goal here is really to kind of align everything and bring it down the middle.
And to touch maybe on that from the user perspective on V2, what kind of benefits can they expect now, or how does the user set interest rate and these new changes translate into benefits, where then also the growth would come, and you need to distinguish between the borrower side, the stablecoin side. I think on the borrower side, yes, I mentioned different LSTs. That's nothing fancy. I think what will be interesting that you have a predictable market rate in V2. I think that's interesting that you set, so it's more predictable. You have more control over the cost and so on. So that's something really unique, that you can borrow on your own terms. No other solution offers that you become a rate maker, not a rate taker. So having this attractive, predictable rate, and predictable again, because in a lending market or in curve, the rate can be very volatile. It can be 2%, it can be 50%. You are just exposed to that, and everybody has the same rate. In Maker, it's the governance. You know it maybe 48 hours before when it changes, but it just changes like governance wants to do that. And we expect much smoother average rate that follows the market. So I think that's interesting on the borrower side. What V1 already had and V2 will keep is high loan to value ratios. So I think it will be a very attractive place to borrow. And just kind of, we got rid in V2 of the recovery mode. So you have even higher realizable loan to value ratios. This also means that you get liquidated really late compared to other solutions. Together with this PIL, with this incentives for liquidity, I think gives you confidence to use the borrowing side, and we also reduced the liquidation penalty. So you see kind of the borrowing experience has some benefits, has some unique features that others don't have. So hopefully that will drive the borrowing side. And on the stablecoin side, I think the biggest change is that now with Bold, that's the name of the new stablecoin, compared to LUSD, you get a native sustainable real yield because you get the yield of the borrowers. So I think that's a really interesting feature of a stablecoin. Now you have DeFi yield. We call it actually the saving side or the earning side of Bold. We compare it to DeFi treasuries. Maybe for the first time, you get something you could compare to treasuries in the real world. And why do people like treasuries in the real world? You don't have a counterparty risk. With Bold, you just have the contracts, of course, but no party, no real world assets, no governance, and you get a decent yield. And that's a product. Right now, I think there's no real alternative where you can get that. So I think that's really interesting. Compared to also V1, to finish maybe just the benefits comparison. With the user set rate, we have a better peg mechanism. So the peg should be more reliably around 1. Can still be volatile. It won't be so good like USDC or USDT. And like with V1 and LUSD, you get a sovereign and risk minimized stable. And maybe we can touch then on that. What's the benefit of a truly decentralized stable? It's just kind of another type of dollar, which, and a lot of people don't know that, is directly redeemable. So you can anytime tap into the underlying liquidity of ETH and LSTs. And that's an important part because most other stablecoins don't have that. You might have a PSM if it's full, but you're exposed also to these risks. So I think that's something that we keep. And that would be the interesting part on the earning side. So together, I think it needs to grow, but you see some innovation benefits on the borrow side, and I think really on the saving side with these DeFi treasuries. Now you have this DeFi building block that's immutable, that it's predictable, dependable, that is running, that has market rates. I think that's a very interesting building block protocols don't have right now to build additional products on top of it. What can you do if you have now this native DeFi yield? Can you use it in perps and other stuff? So that took a bit long, but I just wanted to give that take on your questions, how we see it grow and why.
No, it's perfect. And I kind of want to talk a bit more about that building block aspect and how you guys want to become kind of the interest rate across crypto and DeFi. But first, Liquidity V1, like you mentioned, is one of the most forked protocols. I assume V2 will also be forked quite a bit. Are there any plans for you guys to capture revenue from this? Is this something that you guys considered before, or is this more of a we're doing public because we're building strong, immutable smart contracts, and that's just how it's going to be?
Yeah, we had some learnings from V1. We were forked a lot, and I think there weren't a lot of synergies. So we also thought, how can we create more synergies between what we build and our forks? So the first thing, our code will be source available, but it will have a BSL license similar to what Uniswap did, Morpho, and some others. So this means you still have the code, you see everything, you can read everything, it's transparent. And after 3 years, it will also become open source. But for some time, you can't just copy and fork it, or kind of it's not advisable. So we took the same part, and with that we pioneered a bit the concept of friendly forks. Others have done that too, but we tried, I think, really in a unique way, where we team up with other teams that want to take this solution, this off-the-shelf CDP solution, which allows you now for other L1s or L2s to create a system for native dollar liquidity. Let's say on Arbitrum or on the Gnosis chain, taking the base asset and getting cheap credit on these systems. So I think there we saw a lot of demand. We signed more than 15 LOIs with these parties that are interested to create that like that. And what it helps them is that we don't kind of have a wild growing ecosystem of forks. It's much more coordinated. We try to give them, make them like more distinct between each other, so not everybody uses the same collateral. And maybe also, why did we decide not to deploy 10 forks of ourselves with all kind of different collateral? I think the forking is the easy part. We've seen that with V1 forks, there weren't so many successful forks. So I think the key thing is not the forking. And we have the technological knowledge to do that. But I think the hard part is always the business part, to grow it. And that is just not easy to scale. First of all, it needs to be in your DNA. I think we have that for Ethereum, but for other ecosystems, we are just not the best business development and most rooted in these ecosystems. So we thought key for the success of such forks is that these people are entrenched in the ecosystem, have credibility, understand it, and can develop an ecosystem around such a solution. So that's what we did, teaming up with friendly forks. And then also how we did it is, okay, we give you an off-the-shelf solutions, we help you, we have a lot of synergies on our partners, being it from audits, modeling, and a lot of this stuff that these folks can tap into. And the goal is that they also give something back, mainly to grow liquidity and the ecosystem. So that's how we approach forks and try to give them something, but also get something back for our ecosystem, but also our shared ecosystem.
That makes a lot of sense. And I'm happy you brought up that it's not just about forking. You need to do BD and you need to actually grow in the ecosystem, because it's something that I want to ask about. For stablecoins, integration and composability is key. How do you guys approach this? When you first initially launched V1, how did you approach it? And now, after years, what do you think is like, what makes a stablecoin usable, composable, something that's actually popular on chain? What are some learnings you guys had?
So I'd actually say that there's a number of steps kind of before you get to the usability and composability that are kind of behind the scenes, and a lot of them kind of come back, and Michael was hinting on it. A lot of stablecoins rely on a number of different factors that are almost invisible to users. These could be things like keepers, liquidators, things behind the scenes, and kind of making sure a stablecoin first works the way that it should, that the protocol is active and has kind of a community of people that are doing these things rather than just one team behind them, is step one. So that's a big part of it. Now, when you're able to prove that, that makes a lot of the other parts a lot easier. Things like getting liquidity in, either through DEXs or centralized exchanges, which is harder for most stablecoins, especially decentralized stablecoins like ourselves. Being able to kind of get that is the next step. After that, you can start talking about integrations and things like oracles, getting prices for them that are available on chain, so that you can integrate them into places like Morpho or Aave, so that people can use them as a portfolio with their other assets to borrow and lend against. It is very critical. Once you kind of hit these layers, you can start talking about many other things that can come up, and being able to do kind of some of the off-ramp, on-ramp aspects. But that's 3 or 4 steps down the road, and LUSD, we were going down the road in that, and I think that will help us on our journey with Bold, because we're familiar with these teams. They understand the way that we think about security, the way that we think about developing these markets and ensuring and fostering their success in a decentralized way. So I think that will help us kind of get along the way. It's very critical. I think we look at Bold slightly different than I think we looked at LUSD before my time, but in the discussions that we've had, it's kind of will sit lower in the stack, and there will be people that want to use Bold as a payment asset or want to put it inside of a crypto credit card. But I think that's kind of less the desire, and the desire is more to kind of help foster this building block notion, to help foster a very solid, very robust collateral set, which is something that interests people that are very sensitive to the decentralized nature of stablecoins, which very few stablecoins are able to offer at that level. So kind of the real important thing for us is making a really good asset that is at the same time liquid and accepted in DeFi venues.
Yeah, I think what it boils down to is having really a clear target audience and profile of the stablecoin. So we really target ETH believers, and we want to have this sound and sovereign dollar like these DeFi treasuries. So you can really attract people with that and target that. I think that's a problem of a lot of other stable coins, which lose a bit their profile. And as Colin said, because we are so decentralized, we said, yeah, probably with the properties, will we be the stable coin for payments of stablecoin of choice for payments? We have USDC, we have Tether. It's probably not our turf. But how we built Bold, I think, with this building block and being native to DeFi, I think that's a very interesting growth way. And now with the also real sustainable and predictable yield on the Bold, having something like these DeFi treasuries for treasuries, I think is also more appealing than in LUSD. So you can go to these more crypto native ETH believers communities and offer them something that is differentiating, and there is demand, and hopefully then growing demand.
That makes sense. I want to ask about something that you guys brought up a while back, which is protocols building on top of liquidity, specifically interest rate, like building on top of interest rates. First of all, I want to ask, how do you envision liquidity becoming, I guess, like the interest rate of crypto or DeFi? Is this something you guys are going to actively work towards, or is it more so like we're building a really good product? It will naturally happen. My second question is, what protocols do you think build on top of this? Obviously, typically teams don't like to limit other teams and say, oh, we want this, we want that. But like you guys obviously spent a lot of time thinking about it. So I want to hear like, what would the ideal protocol look like? What are some things that you guys have explored?
Yeah, so I think there's kind of some important things. I mean, interest rates. So the way I like to talk about finance in general is I think finance is a discipline that looks at two things. It moves money or value across space and time. In crypto, in DeFi, we've been very good at kind of moving money from one pocket to another. Blockchains are very good at doing that. Tokens are very good instruments for doing that. With kind of more elaborate finance, we start looking at moving across time. With DeFi, most things are very short term. We're able to put money in. It's got a variable rate. That rate goes up. Everybody leaves the market pretty quickly within a matter of minutes, hours, days. Compared to TradFi, it's very, very quick, very, very short term. Now, that is a limiting factor if we want to do something that is real world. Very few people can say, "Hey, I'm willing to put up enough ETH to over collateralize a loan, and then if those interest rates become too high, I can swap out of those and move my solution someplace else or out to TradFi." That would allow me to go out and buy a large purchase like a car or a house. So that's a very limiting factor that almost makes DeFi completely irrelevant to anything real world. Or even kind of coming a bit closer. If I want to do something like invest in a private round for a token or a startup and buy equity that's locked for months or years, using DeFi may not be a great solution. And this is something that a lot of people do. It's less grandiose than going through the onboarding, but funding a team that wants to launch something and taking a part of that is something that a lot of people in this industry do. That is something where having a more dependable interest rate could become part of that. You could also imagine being able to strip that out and say, well, there's the other side of this. And those interest rates become very useful if we want to be able to discount cash flows. Because again, we're moving money across time. We're moving future money to today. And that looks very much like a discount rate. So lots of people talk about things like Pendle, and Pendle does a very good job at doing that. So there's an argument that some of the principles that Pendle's looking at would be things that would be very complementary with what we're building. The other thing that's quite popular in crypto, especially now, are perps and derivatives. Most of those are done either with very centralized systems or they're done with very volatile rates. The funding rates can be much more volatile even than Aave. Being able to kind of rein that in so it looks more like traditional markets makes those markets themselves tradable. And that's something that's really big. To give you an idea, in TradFi, interest rate derivatives outstrip the size of equity derivatives, things like the S&P 500 or the FTSE, by a margin of 1,000 to 1. They are just absolutely gargantuan markets. Being able to bet on the interest rates of the US dollar is massively larger even than the dollar treasury markets. These are massive, massive, massive markets. And being able to do that inside of DeFi is something that opens up a lot of doors, be them derivatives, be them a user that wants to lock in rates, wants to be able to lock in their borrowing cost, wants to be able to speculate on what rates might be in the future, are markets that are just ripe for development. And there are some teams that have started to look into that, but are limited by the liquidity beyond a very short term.
And the simple answer also to that is that we build V2 a bit more open than V1. So it's easier to build on top of it. So, for example, that others can repay your debt or increase and reduce your collateral. So interest rate swaps are possible. So trying to make that more open for other protocols where V1 was maybe more closed.
So in V1, all protocol revenues generated by the fees associated with opening positions and redemptions would flow to stakers of the Liquity token. And across crypto, we've seen a lot of teams be averse to turning on a fee switch or returning fees to token holders, whether it's given the regulatory climate or the development team would rather just pocket the revenue for themselves. So there are really few such cases of protocols returning revenue to token holders. So I'm curious how your team has navigated this regulatory climate as it relates to returning fees to the token holders. And then specifically, what will be the role of the Liquity token for V2?
Yeah, maybe let's start with the second one. So I think what we realized is that we have a really good user base of the token holders of LQTY. There wasn't a governance so far, but it's well distributed. 97% of the tokens are distributed. People are very value aligned, so we wanted to leverage that. So LQTY plays also a role in V2. So you have like with LQTY, like this dual reward opportunity. You can stake it in V2 and you still get like in V1 when you staked it, the revenues. And on top of that, when you stake, the longer you stake, the more voting rights you get, which I think it's a very interesting mechanism. So if I stake for a year, I might have 10 more times the voting rights than when you started. But if I unstake, I lose all of them. So it's kind of totally the opposite of this VE economics, where you get first locked for a long time. So with us, you don't get locked, but you lose a lot if you go out, which I think is very nice and elegant and value aligned. And what can you do? As Colin mentioned, so there's a 100% pass through of the borrowing interest. 75 goes to the stability pool, to the holders, which I think are very important in the ecosystem. And then we think for a stablecoin, it's also important to provide liquidity for the stablecoin. And that's an unsolved problem. How do other protocols solve that? Somehow, maybe there is a founder, maybe there is a governance that does all the coordination. So we found for an immutable solution, we want to give more certainty to users and ensure on a protocol level that users can take care of liquidity. So 25% goes into that bucket, which is mainly aimed for liquidity, but of course needs to be ideally immutable, which it is, but also adaptable. So that's important. All the stakers and the people that can vote can't change anything on the core protocol, like in V1, not upgradable, not immutable. The only thing they can do is decide on an ongoing basis where are these 25% best used. And we think initially what we will enable are that it can be routed to liquidity, be it Uniswap or Curve and so on. So they can decide where should it go, but it's a very open and flexible module. I think it's in the interest of the users, LKDY holder, to first grow the system, ensure liquidity, and then the system is very open. You can bring in new modules, and divert the revenue where you think it adds most value.
Perfect. I feel like this is something we haven't discussed yet, and it is probably one of the most important things. Why do we need decentralized stablecoins? Why? I feel like a lot of people don't really get it, and you guys might be the best team out there to evangelize this.
It's a funny one. It's kind of like insurance. You don't need it until you do, right? We saw USDC depegged. Why did depeg? Because there's dollars in a bank account, and people woke up one morning and realized that the bank that those dollars were in no longer existed, and that the Federal Reserve had to come in and kind of bail them out, and they may not. So having any kind of concern about that is something that people should worry about. I mean, if you ever worry about where your money's sitting, if you ever spend any time trying to diversify risks, one of those key risks is, who's holding your money, custody risk. And even for TradFi, that's a very important topic. So for us, we have Tether, we have USDC. They represent more than half of the stablecoin market, which is held inside of a small number of financial institutions. That's essentially a backbone of the value inside of global crypto. That's super important. So being an alternative to that, we feel is a very important thing to people. As I stated earlier, lots of users have came to us and said decentralization, immutability is important. Not having those rules changed and rug pulled underneath us when we've already invested in it is a very good thing. I think the other thing that's kind of maybe underappreciated is having not only being decentralized, but having your underlying asset redeemable by anyone. Anybody can grab that underlying asset. Means that our stablecoin can be liquid against other stablecoins or other assets, but you can also get an asset that is actually Ether, which makes it as liquid as Ether. So by virtue, I would make the argument that LUSD is above and beyond USDC or Tether and is more liquid because it is exactly as liquid as Ether, which is massive. So being able to get those assets, being sure of where they are very, very important things in the times of crisis. And as I said, you probably don't care until the day you wake up and realize that you should have. That's why we're trying to be here.
Yeah, and I mean, to add on that, I would say maybe LUSD and then BOL is one of the soundest dollar you can hold as a crypto person and tech person. And it's all about control. Who controls your money? Is it an institution? Is it somewhere else? Is it the state? Or is it yourself? And then I think that's why I think BOL and LUSD is the soundest dollar, because only you control it. You mint it yourself. You can redeem it yourself, and nobody's in between. No intermediary. Nobody can stop you. You have all the control, and I think that's very unique. Gives LUSD and BOL a very unique risk profile. So it's about control. Are you in control? Are you dependent on somebody or not? And I think there we are very unique. And the other thing is just the risk associated to dollars. A lot of people, because they don't understand the financial plumbing and financial systems, aren't aware that not every dollar is the same. Every dollar has a different risk profile. And LUSD and BOL have just a very unique risk profile. I'm not saying that you need to have everything in there, but actually, if you think of it from a risk perspective, you should diversify and always hold some of your portfolio, maybe also in LUSD and BOL. just because it has no counterparty risk. USDC and USDT have a counterparty risk. Okay, maybe you like regulation and you think it's safe, so it's fine. But just kind of, okay, just for the case, like, I mean, we had it with our own treasury when the banks went down, we couldn't wire any USD. Just because, banks weren't able to do that in Europe. Then you have the collateral risk. Bold and LUSD is over collateralized and with crypto. So for a crypto person, that's really cool because your dollar in your bank, it's under collateralized. You know, the bank only holds 10% of your dollars that you see in your e-banking actually there. So you can't directly redeem. And if everybody redeems you, we have the Silicon Valley Bank debacle. And so on. So I think that makes it really interesting if you start to think about the risk that are associated with the stablecoin and the control you have. So I think, that's why LUSD and Bold is really geared towards ETH believers, crypto natives who care about these topics and who don't want to be dependent. And I think for these people, they're a very interesting solution.
So at large, we've seen the centralized stablecoin market generally be 50 to 100x the size of the decentralized stablecoin market. And even though DAI might be considered the incumbent in decentralized stables, it's still substantially collateralized by USDC and off-chain loans. So I'm curious how you see the decentralized stablecoin market changing or growing over time, particularly with the launch of the Bold stablecoin, and how much market share you think decentralized stables can actually take against centralized stablecoins, particularly with a better stablecoin product.
I think it's, I'd frame the question slightly differently. I think uh, decentralized stablecoins have the ability to expand the market rather than take market share. I think there are a lot of people that use USDC and USDT for specific purposes around payments. Now, there certainly is a lot of USDC and specifically USDC, but also USDT and DAI, which, as you stated, is not 100% decentralized. We'll come back to DAI in a moment. Inside of DeFi products, and I think that if we have a good alternative that's decentralized, there will be a contingent of people that move there. There's also some kind of regulations on the horizon. So I'm based in Europe. One of those may have impacts on taxation, which are more favorable for non-e-money classified stablecoins, meaning ones that aren't actually backed by dollars, may receive more favorable tax treatment. Now, that could be a tailwind for protocols like us, but I think the real big thing here is by having a stablecoin that isn't subject to any blacklisting functions or doesn't have any controls or ability to be lost, opens up the possibility to have kind of these multi-month, multi-year markets that people may be less comfortable with existing stablecoin solutions. So it's really an expansion that I think we can get. I think, as Michael and I were saying, we don't really see this kind of eating into a payments use case. So it's not so much about taking away from what's there, but it's really about creation of new money because there is virtually unlimited dollar demand.
Fantastic. Luke, do you have anything else that you want to ask?
That's all for me.
It's all for me as well. Guys, before we wrap it up, do you have any place that you want our listeners to go to specifically look at? Is there any place that you would guide them towards to do more reading or more research?
Sure. So first, our website is liquidity.org, where you find already some information for V2. We have also released the code. We have a very extensive and thorough README there for the technical interested ones. We have a blog post sharing more information. There you also find the white paper. So there's already a lot of information out there. Then our Twitter at Liquidity Protocol. That's, I think, the best way to follow us. yeah, I would say these are the resources. And to touch also on that topic, timeline and so on, where do we stand? I mentioned 9 months ago, we started the project. Right now, we freezed the code. We are in audit process. The first audit passed. We have a second audit. We're doing some formal verification. So fingers crossed that we don't have to go back to the drawing board. Potentially in 2 to 3 months, we aim then to launch.
Perfect. Guys, thanks so much for coming on. This was a fascinating episode. I'm really excited to see Bold come
Thank
out.
you very much.
Fantastic.
A great chat. Thank you, guys.
Thanks, guys.